I want to talk about money, specifically what leaving corporate actually costs, not in a vague, make sure you have savings way, in a specific, honest, this is what actually happens way. Because most people I talk to significantly underestimate this, not because they're irresponsible, but because when you're still employed, the numbers feel abstract, the salary arrives, the direct debits leave, the balance stays roughly stable, and it's easy to assume that with some planning, the transition will look similar. It won't, and I want to tell you why. When I left, I thought I had a reasonable cushion. I'd done some rough calculations. I knew roughly what I spent each month. What I hadn't done was look hard at what I actually spent. There's a difference. So here's what I'd suggest before you do anything else. Pull up your last 3 months of bank statements, all of them. Not to judge yourself, just to see clearly. Most people are surprised by what they find. Subscriptions they'd forgotten about, costs that felt small individually but add up significantly. The work-related spending that disappears when you're not working but gets replaced by other things. Now here's the part nobody tells you clearly enough. It's not just the loss of income you need to plan for, it's the gap. The average time between leaving a senior corporate role and generating consistent replacement income is longer than people expect. I'm not going to give you a specific number because it varies enormously, but I will say this: if you're thinking 6 months, plan for 12. If you're thinking 12, have a plan for 18. That sounds uncomfortable, is meant to. Not to stop you from leaving, but to make sure that if you do, you go in prepared. There are also costs that people don't anticipate at all. Healthcare if you were covered through your employer, professional memberships, the cost of building something new, whether that's a business, a side income, or retraining. These things add up. And then there's the psychological cost of watching the balance go in one direction, even when you have a plan. Watching savings reduce month after month does something to your thinking. It creates pressure, and pressure affects decision making. People take opportunities they wouldn't have taken otherwise because the financial clock is ticking. I know this because I did it. I took a role after leaving corporate that I knew wasn't right. I took it because the alternative was watching the balance drop for another few months, and it cost me time and confidence I didn't get back quickly. So what's the practical takeaway? If you haven't left yet, build a real picture of your actual monthly spend. Then double the runway you think you need, not because you'll use it all, but because having it means you make decisions from choice. If you've already left and you're in the gap, the most important thing is to avoid making permanent decisions from a temporary position. The pressure is real, but decisions made under financial pressure are rarely the right ones for the long term. And in both cases, the single most useful thing you can do right now is get clear on the numbers, not a rough idea, the actual numbers. Pull up those bank statements. If this was useful, subscribe. New video regularly. And there's a free worksheet in the description. It's not about finances, it's about burnout versus outgrowing work, worth knowing. See you next week, and remember, subscribe for a new video every Wednesday.